Hi guys, Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. Well, I'm sure that you guys are aware that we hit the debt ceiling tomorrow, okay? And they've already started talk about raising the debt ceiling, making extraordinary steps to postpone, etc. But I want to show you what the real problem is, because frankly, they've raised the debt ceiling, 74 times since 1962? So big deal. Why just not do it again? What makes this time different? Let me show you. Number one, and remember, we'll have JPEGs on all of this, so just click the link below and go look at these graphs. But number one, this is the graph on the deficit spending. So you can think of this like a government credit card. You can see that when the debt limit was set by gold, you basically had to stay within a budget. But once we went off of that, which you can see right here, and Congress sets the debt ceiling, well, you can see what's happened ever since. Perpetual deficits. The big problem with that, which I'm going to talk more about next week, is compounding interest. So this is income, the bottom one, that's spending. We're already spending more than we're taking in. But even if we were to stop spending, we are still going to have that debt grow because of that compounding interest. So that's the problem going into this debt ceiling. All right, well, here you go. The debt ceiling has been hit at 20 trillion, or it will tomorrow. Now, what I want you to notice on this is the pattern, right? Smooth lift takeoff since we became debt-based. In 97, a lot of things had changed. Rules and regulations had changed, long-term capital management. But notice that after that, every time we hit a recession, the speed of the growth of the debt increased. And look at this pattern that we're seeing since the crisis hit. Do you see it that choppy anywhere along here? So remember, when you step back, when you're in the middle of it, you can't see the pattern. But when you step back and look, it becomes really clear. And here's why 97 is really a very big issue. This is the monetary velocity chart, so it indicates whether an economy is being stimulated. The growth of debt stimulated the economy, and we hit peak growth in 97. After that, the weight of the debt and the compounding interest has dragged the economy down. So even though President Trump is talking about spending all of this money, and I mean, we'll see if they raise the debt ceiling or not, that's still not going to likely be stimulative because nothing has since 97. Do you see that? Well, maybe that wouldn't be such a big problem, except for this. I love how they name it, okay? But this represents the funds, all of your and my taxpayer funds that we put into Social Security and Medicare Trust Fund. And remember, those benefits are paid out of current contributions. So any of the excess was borrowed via treasuries. So they took the money, spent it, and left you with treasury debt. Now look, the baby boomers, first of us started taking Social Security in 2013. We're going to be talking more about this in another webinar, but you've got a tsunami of baby boomers coming up behind those, and they're all going to want Medicare and Social Security. Plus, the older we get, the more health care costs. Can you start to see the problem? It's not just one debt ceiling, it's everything else that they're doing. And I only showed you those two little areas. But let me make this personal for you. Because you and I, oh, well, so that's them and we're us. No, no, no. The debt is what the government commits you to on their behalf. So here, this is per citizen. Debt, now this is also net. Can you show them that bottom one? That's net debt. That's not the compounding debt. And then you have the debt per citizen that we're responsible for. And then you have those unfunded liabilities, Medicare and Social Security, because all that money has been spent. So, the average income is 48 grand. Could you really afford that level of debt on that income? Can you see the problem? Now, here's another truth. Because all of this new debt that they want to issue, this is the Federal Reserve buying Treasury bonds, all right? Look, they started doing it in 2002. So already at that point, they weren't generating enough interest in our Treasury bonds to fund their deficit spending. This is hyperinflation, okay? Or it's a hyperinflationary pattern. Okay, that's QE1, QE2, QE3. So are they the only buyers of our debt? Well, pretty much, yeah. Because look, remember, foreigners are selling off our debt. So who's going to buy when we raise the debt ceiling? Which we'll see what happens. But, if they don't do it, we're going to have a government shutdown. And at the speed that they are burning through that cash, that could come this summer. It could actually even come earlier than that. Can the markets really afford that? Now, keep in mind, too, next week I'm going to talk about the impact if Janet Yellen raises the rates tomorrow, which I think she will. I'm going to talk about the impact of that and wait until you see what I found. But I definitely want to leave you with this chart, and you should recognize it because I've been showing you the interest on the 2-year Treasury. And look, it had just broken above that line the last time I showed you. Look at where it is now. Now you have the 10-year Treasury that has broken above the line and just barely on the 30-year bond. So the markets have been moving interest rates up, and this has really been in a concerted way because remember all the derivatives against them? We're going to talk a whole lot more about this next week. But I hope you understand from this that we are responsible for this debt. The debt, it's not just that it's not sustainable. The system is breaking down. Everything I showed you, that's what it's telling me. You see those pattern shifts. So tomorrow should be a very interesting day. I will see you on Thursday. Like us on Facebook. Subscribe to us on YouTube. Follow us on Twitter. And give us a call. 888-696-4653. Bye.